Professor Sotkamp here. In this video, we're going to talk about accounting for accounts receivable, and specifically adding in accounting for what we call bad debts. When we talk about accounting for accounts receivable, we've studied this in the past. We know a decent amount about accounts receivable, but there are some additional things that companies need to do in regard to their accounting for the amounts that their customers owe them. So again, accounts receivable represents what our customers owe us for the goods and services that we've provided to them. In my example here, we have the January sales of Adams Coffee Company. January sales. This is my company, made it up. Okay, and these are my customers. I have 10 customers. And during January, I sold the following amounts to each one of these customers on account. All sales are net 30, so the customers have 30 days to pay me. And what would I record then for these sales here on the month of January, or in the month of January? So if I go back here, I'm going to record January sales. I'm just going to put January here in the date column. I'm going to record the fact that my customers owe me money, accounts receivable. How much do they owe me? They owe me $5,145. And I get to record this as sales revenue. Now, I'm selling coffee pots or coffee makers of some kind. And so that's what I would record. I would also need to record the cost of goods sold and the inventory reduction and things like that. But again, we're kind of skipping that part of it for this chapter. So I have accounts receivable and I have sales revenue. My customers now owe me money. What happens next? Well, in the normal course of events, we would hope that our customers would pay us within these next 30 days. So hopefully we'll just say by the end of February. Unfortunately, there is a risk. There is a risk inherent in doing business this way. What is the risk? The risk in allowing my customers to take my products and not pay me for them right away, right? The risk that I run is that some customers may not pay. Right? Some of my customers may not pay me what they owe me, and they've taken my stuff. So I'm running a risk in doing this. Now, I do it because it actually facilitates more business. If I were to require everyone to pay me cash as soon as I gave them a product, I would probably have fewer customers. They would go somewhere else that allowed them to buy stuff and pay for it on their own timetable. So I have a risk. Now, as I go forward, what am I going to do? As I go forward, I need to account for that risk. I need to account for the fact that there are customers who may not pay me. When I have customers who may not pay me, that is what we call bad debt. So bad debt are customers who don't pay. So they owe me money and they don't pay me. Now, the cost I incur related to this, because I am incurring a cost, right? I am incurring a cost related to extending credit to my customers. The cost that I incur is the amount that I don't receive, right? The amount I don't receive from my customers. And so we have a cost to this, which we call bad debt expense. So that is the cost, right? Let me do it in blue. That is the cost that I incur to allow my customers to buy on account. When we have expenses, if we remember anything from our previous discussions, when we have expenses, we have to follow what principle? We have to follow the expense recognition principle. Which means, right? What does that mean? That means record when incurred. This is also what we refer to as the matching principle. So when do I incur the cost related to my January sales? Well, I actually incur the cost related to my January sales when I make those sales to those customers. Because even though I don't know it yet, as soon as I make that sale to that customer who's not going to pay me, I've just incurred a cost. I'm not going to find out that they didn't pay me for quite some time, in all likelihood, but I have incurred the cost. In addition, when we record expenses, we have to match them to the revenues, right? That's the matching principle. Expenses from January have to get matched to revenues from January. And so I have January revenue recorded in my journal right now, which means I need to record January expense for bad debts right now in my January journal. The problem is I don't know which customers are not going to pay me, right? I've got 10 customers over here that I sold stuff to in January. If this is my first month of operations, then these are my only customers, right? They're the only ones that owe me money. And these are the amounts that they owe me. I don't know which customers are not going to pay me yet. And so what am I going to have to do here? I have to record bad debt expense for January. But since I don't have a specific customer that I'm aware at this present time is not going to pay me, I have to estimate. So, first thing we're going to have to do here is estimate. Now, there are two ways that you can do this. So let me do this with A. The first way is by doing what's called percentage of sales. And the second way is basically percentage of receivables. So in our case here, with this being the first month of operations, our sales and our receivables are the same number because we sold stuff and we have the receivables associated with them. Now as time goes on, those numbers diverge. Sales from each month don't always add up to total receivable balances. But for the sake of illustration, this will work. The first thing I have to do is estimate. So when we estimate using the percentage of sales method, which is what we're going to walk through in this video, we take a percentage of our credit sales and record it as our bad debt expense. And so I'm going to write a formula here. This is for percentage of sales, where bad debt expense is equal to your credit sales, that's your sales on account, times a percentage that you think is uncollectible. Okay? The amount you think is not going to be collected. And so we're going to record that here in a minute. That's how that works. But before we do that, what's the typical course of action? When we look at accounting for accounts receivable, right? We have sales on account, and then we expect to collect some of those sales. So let's say that during the month of January, we collect from Logan's Latte Lounge, we collect from Molly's Mocha Mansion, from Tripp's Cold Drips, we collect from Manny's Macchiato Market, and we collect from Dwight's Flat Whites. And so if we collect from all of those customers, then what would we record? We would then record, let's number these transactions, the collection of cash. So we would collect cash from the customers. That would be a total of $1,955. And we would get rid of accounts receivable, $1,955. And that's what we hope happens, right? When we sell an account. But, as we stated before, it is possible and in all likelihood probable that our customers, we may have some that don't pay. And so we have to record our estimate. So at the end of the month of January, transaction 3 here, at the end of the month of January, we're going to record our estimate. Now, for our calculation here, our credit sales for the month were $5,145. Okay? We sold $5,145 worth of stuff to our customers on account. And we expect, this is an estimate, we're going to throw out a number here. Let's say that we expect 5% of that to be uncollectible. If that's the case, 5% of our $5,145 is $257. And so I would record my entry at the end of the month of January. I would record bad debt expense of $257. Now, as we know, with journal entries, if we debit something, we're going to have to credit something, right? Now, the logical thing for us to do here, if we think through this, would be to say, all right, well, if we don't expect to collect the $257, that's our cost, right? Our bad debt expense. If we don't expect to collect that from our customers, then we would get rid of the accounts receivable. But we have a slight problem with this. Because as we said before, right now, what are we doing? Right now, the first thing we have to do is record an estimate. Right? Why are we recording an estimate? We're recording an estimate because we don't know which ones of our customers over here, right, are not going to pay us. Well, who still owes us money? Well, we've got Joe's Joe Depot still owes us money. Callie's Cappuccino Castle, Avery's Americanos, Evelyn's Espresso, Paul's Pour Over Place. They still all owe us money. I don't know which one of these customers is not going to pay me. So that creates a problem. And it creates a problem because of something that we haven't really discussed. And that isn't discussed very much in introductory accounting textbooks either. So we're going to scroll down here and do a little bit of a side illustration. Here we have what would be considered a chart of accounts. Now, a chart of accounts is essentially the financial statement accounts. The chart of accounts includes those financial statement level accounts. It also includes all other accounts. But for the sake of our illustration here, we're talking about financial statement level accounts. Why do we call them that? Because these are the accounts that we see on the financial statements, right? I didn't put numbers in for all of these because I didn't want to make them all up. But let's say that this is our chart of accounts. Now, you see here, some of them start with ones. Those are the 1,000 value accounts here, and those are our assets, right? We have a liability here that starts with 2,000. Equity accounts start with 3. Revenues are 4, and expenses are 5, right? And so we account for our transactions using these account numbers. And these accounts, right, are the ones that we're going to see on the financial statements. However, most of the actual transactions that we're going to record in our accounting system are not going to use these account numbers. Most of the transactions that we're going to record are going to be recorded using what we call subaccounts. Okay. For example, we have accounts receivable here. Account 1100, accounts receivable, that says that our customers owe us $5,145, right? That was as of, January's sales figure that we started with. So that's the number we would put on the balance sheet for accounts receivable, right? That's what our customers owe us. But I'm going to want to keep track of how much each individual customer owes me. And so I am actually going to use subaccounts to do that. So Joe's Joe Depot, I have my own account in my accounting system for this customer. It is account 1100.1. Right? It falls under the 1100 financial statement level account, right? Logan's Latte Lounge is 1100.2, right? So these are the accounts that I'm actually going to use to record things. Now, the reason that we have a little bit of a problem here is that we don't teach this typically in introductory accounting classes. We usually just teach, right, using these, right? Just these financial statement level accounts. But the sub-accounts are what is actually used because I want to know how much each one of these customers owes me so I can keep track of it. And then when all of these accounts roll up, right? When all of those individual accounts roll up, what do I have? I have my account receivable balance, right? So I'm looking at this and I'm saying, all right, I don't know which one of my customers is not going to pay me. So I record bad debt expense. But I can't credit accounts receivable because I would have to choose one of these customers' accounts to get rid of. Right? These customers' accounts are the amounts that add up to my balance in accounts receivable. So I can't get rid of any of that number until I know for sure which customers are not going to pay me. So when I come up to my journal, I can't credit accounts receivable here. I'm going to credit an account that we call allowance for doubtful accounts. Okay? Allowance for doubtful accounts. Now, allowance for doubtful accounts is an account type we've seen before. It is a contra asset. Okay, contra asset. So later on in the videos, we will see how this plays out in terms of the balance sheet. But that's what I would record, right, for January. I'm going to record those transactions. Now, I'm going to create here an account for accounts receivable and an account for this allowance for doubtful accounts. My allowance for doubtful accounts now has $257 in it. And my accounts receivable, based on after my sales collecting those amounts that I said I collected, right, started out with $5,145. I collected $1,955. So my accounts receivable balance now is $3,190 going in to February. And so we're going to move on from here. We're going to move on into February. Now, in February, here's what happens. I make sales again to my customers. So I'm going to record the fact that I sold stuff to my customers in February. So I'm going to record accounts receivable, $3,255, and I'm going to record sales revenue, $3,255. And now I determine sometime in February, I have identified a customer that is not going to pay me. So I have step number 2. Right? We said first step, letter A there, estimate. The second step, okay, we're going to say B, is to write off. Okay? I'm going to highlight it like the other one. Write off. So, what happens? Well, I have determined that Callie's Cappuccino Castle is not going to pay me. Callie's Cappuccino Castle just went out of business. They went bankrupt. And so I'm not going to receive the money that Callie's Cappuccino Castle owes me. How much do they owe me? Well, in January, they purchased $175 worth of stuff from me. It's the only time they purchase anything from me, so that's what they owe me. But I've realized they're not going to pay me. So what do? Well, if Callie's Cappuccino Castle is not going to pay me the amount that they owe me, and I'm not going to get it based on what I've determined, then I need to get it off of my books. Because I don't want to keep telling my readers of my financial statements that I expect to collect it, because I don't. And so what do? Well, the first thing I'm going to do is I'm going to credit accounts receivable for $175. Now, in reality, what would I do? I would credit Callie's Cappuccino Castle's account receivable, right? The specific one that I have for that customer. Now, what do I debit here? Well, I'm going to debit my allowance for doubtful accounts. Again, this account is the one I set up in order to account for those customers who I had yet to identify that would not pay me. Once I've identified them, then I can get rid of the allowance that I set up for them. So that is what we call a write-off. Okay, so I'm going to start numbering some of these transactions. So in the first transaction, we record the sales from February, and then we recorded the write-off. Okay, write-off. So that's going to happen, right? That's the second step. First step is to estimate. Second step is to write off. Now, when I get to the third step here in terms of what's going to happen, I'm going to collect some of this stuff from my customers. So I sold some stuff for them in February. Who am I going to collect from? I'm going to collect from Logan's Latte Lounge again. I'm going to collect from Molly's Mocha Mansion. I'm going to collect from Trips Cold Drips. And I'm going to collect from Dwight's Flat Whites. These customers pay me regularly in the month in which they make purchases from me, which is great. And so how much have I collected in cash as a result of this? I've collected $1,530. And I can get rid of their account receivable balances. $1,530. So if I go back up to my accounts, what's happened? Okay, my account receivable balance was $3,190. It went up $3,255 for February, but it went down to $175 when I wrote off my account for Callie's Cappuccino Castle, and it went down $1,530 from collecting cash from my customers. So by the end of February, right, this was January's balance. By the end of February, where am I at? By the end of February, my customers still owe me $4,740. My allowance for doubtful accounts account had a balance at the end of January, right? This was January's balance. Had a balance of $257. I wrote off an account for $175 during February, which leaves me with a balance of $82 at the end of February before I record my adjustment. So this is the unadjusted balance in my allowance for doubtful accounts. Last thing I do in February again is estimate. So you see this cycle back and forth. What am I doing? I have to estimate how much I think my customers will not pay me. Then, as I go, I write off accounts as I determine them to be uncollectible. And at the end of the next month, I'm going to re-estimate how much I think is going to be uncollected. And so if I'm continuing to use percentage of sales here as my method, what do? My bad debt expense is equal to my credit sales times the percentage that I think is uncollectible. So my credit sales for the period in February were $3,255, and I'm expecting 5% uncollectible, which means $163. So I go down in my journal, and my end of February, I'm going to record bad debt expense, $163, and I'm going to record allowance for doubtful accounts, $163. I post my adjustment, $163. Where do I end up? I end up with $245 in my allowance for doubtful accounts. And so this process, estimating, writing off, estimating, writing off, is how we do accounting for bad debts. This is just a walkthrough of the percentage of sales method. We're going to do another video where we walk through the percentage of receivables method and how it works. Is a little bit different. So, looking at the balance sheet, what would this look like at the end of February? We'll try to squeeze it in here at the bottom. On my balance sheet, right, I would have assets, and I would be looking at current assets. So let's see if we can kind of shape this off here. First current asset is going to be cash. I don't exactly know how much cash the company has right now, and that's okay. My account receivable balance at the end of the period is $4,740. I have a contra account called allowance for doubtful accounts. Now, contra accounts, again, are those that have opposite balances in terms of debits and credits. Just like accumulated depreciation is subtracted from equipment or buildings as a contra asset, we are going to subtract the allowance for doubtful accounts from our accounts receivable. Well, we have $245 in that account. That leaves us with accounts receivable net of the allowance, just like equipment is net of depreciation. Accounts receivable net of the allowance of $4,495. So that's how our accounts receivable portion of the balance sheet is going to change. Now, this value here is what we call the net realizable value. It's the amount we actually expect to collect from our customers. Our customers owe us $4,740, but we expect that we will not collect $245 of that, which means we do expect to collect $4,495. So that's the net realizable value, the amount we actually expect to get from our customers. So this is a walkthrough of the percentage of sales method and approach. The percentage of receivables is a little bit different, but generally speaking, the transactions we're going to record are going to be very similar. So we'll take that up in the next video.